faithfully delivering value, interpreting great books worldwide. Hello, this is Sally's Book Talk. Today, we're diving into this book by renowned American financial writer Michael Lewis, Liar's Poker. Oh, this can be seen as a prequel to the 2007 U.S. subprime mortgage crisis. The direct cause of the subprime crisis was the flood of financial derivatives. And this book aims to reveal how these seemingly complex financial derivatives were created, how this game is played, and how it ruled the market. Oh, in Lewis's view, the financial derivatives market is essentially a game of liar's poker. The so-called liar's poker is a very popular form of gambling in American finance circles. The players sit in a circle, each drawing a dollar bill randomly, then guessing the serial number distribution. Whoever convinces others to believe them wins the game. For example, if someone calls 3 6s, it means that among all the dollar bills held, there are at least 3 6s. Then other players can choose to challenge or raise the bet. For instance, if you call 3 6s, I might call 3 7s, 3 8s, or 4 5s. Um, in this process, each player tries hard to convince others of their guess. Only when all players challenge one player's call can they reveal their serial numbers to determine the winner. This game tests players' courage, willpower, and ability to charm others. Each player tries to deceive or intimidate others into believing their judgment. On the surface, this game tests players' knowledge of probability and statistics. But the real challenge lies in deceiving others while seeing through their tricks. During the game, players constantly ask themselves, is taking such risks wise? Why is he calling so loudly? Is he bluffing me? Oh, what if not? You see, each player is speculating about others' weaknesses, foresight, and behavior patterns. The author Lewis learned this game at Salomon Brothers on Wall Street. When he was an intern there, he heard such a story. At that time, John Merriweather, who led Salomon's bond trading department, was recognized as a genius trader on Wall Street. At the heart of a fierce tiger and unstoppable momentum, his trading techniques are sharp, truly an investment prodigy. And the boss of Salomon Brothers was named Goodfriend. Oh, his nickname was the King of Wall Street, a truly powerful figure. One day, Gutfriend suddenly came to the trading floor, found Merriweather, challenged him to a game of liar's poker, betting a staggering $1 million. That was $1 million in the 80s, worth at least tens of millions today. The entire trading floor was stunned. But Merriweather, without hesitation, called the bet, confidently announced his guess, and stated his own bet amount. $10 million, no takebacks. Seeing Merriweather's hawk-like gaze, even the king of Wall Street finally backed down. Gutfern shrugged non-committally and left. The market that most resembles liar's poker is the financial derivatives market, especially the mortgage-backed bond market, pioneered by Salomon Brothers. As a bond salesman at this company, the author, Michael Lewis, fully experienced how Solomon created financial derivatives to dominate the market, only to be consumed by the market itself, declining from prosperity. This experience allowed the author to examine everything from an insider's perspective. This examination unfolds through two threads. First, how Salomon Brothers single-handedly created a derivatives market over a decade. The second, how the author himself grew from an intern into an excellent investor. Banker? And how did he witness Salomon's rise and fall? Let's first look at the first thread together. Salomon Brothers is an old Wall Street investment bank founded in 1910 by the three Salomon brothers and partners. By the 60s and 70s, it had become one of Wall Street's leading investment banks. In 1978, the elder Salomon retired, and John Gutfriend succeeded him. Lewis recalls in the book that it was Salomon Brothers who invented mortgage-backed bonds. Specifically, they bundled countless home mortgage loans into a package, used it as collateral, and issued bonds sold to investors worldwide. From then on, with this unprecedented financial innovation, American homeowners could finance their homes from global investors, greatly reducing financing costs and boosting purchasing power. By spring 1978, the success of mortgage-backed bonds led Salomon to establish Wall Street's first dedicated mortgage bond department. Subsequent developments proved how visionary this move was. In 1979, the Federal Reserve implemented interest rate liberalization policies. In 1981, Congress passed legislation to marketize mortgages, meaning packaging them into bonds for public trading. At this time, Salomon possessed Wall Street's only fully established independent mortgage bond division. Any U.S. mortgage lender wanting to sell their loans could only turn to Salomon. During the golden 1980s, profits from Salomon's mortgage bond division equaled all other departments combined. Next, Salomon successfully persuaded the federal government to guarantee mortgage-backed bonds. From then on, most mortgage bonds received the U.S. government's credit endorsement, achieving AAA ratings, equivalent to U.S. Treasury bonds. This was a classic credit transfer operation. Transferring U.S. national credit to mortgage bonds enabled them to secure massive financing at extremely low costs. By this point, Salomon had effectively gained rulemaking authority over Wall Street's mortgage bond market. Mortgage-backed bonds carry inherent risk. Homeowners might prepay loans, but bond returns depend on interest payments. 8. If debtors repay early, creditors lose substantial interest income. Thus, creditors face significant risk from early loan repayments. To manage prepayment risk, Salomon innovated financially by launching collateralized mortgage obligations, CMOs, in June 1983. Here's how CMOs worked. First, pool numerous mortgage-backed bonds, then use them as collateral to issue new bonds. These new bonds were split by maturity dates, with shorter-term bonds repaying principal and interest first. Longer-term bonds initially paid only interest, beginning principal repayment after short-term bonds were settled. This arrangement meant long-term bonds corresponded to normally repaid mortgages, while short-term bonds matched prepaid loans, giving investors choice based on preference. If investors dislike risk and want their principal back early, they can invest in short-term bonds. The shorter the term, the lower the risk, and of course, the smaller the returns. If investors prefer amplified returns, they can invest in long-term bonds. The longer the term, the higher the profits, and naturally, the greater the risks. This effectively transferred prepayment risk to the entire capital market, removing investors' concerns. Consequently, investors entering the mortgage bond market and trading volumes exploded. The mortgage bond market rapidly became the largest component of the U.S. capital market, even surpassing stocks and regular bonds. 5. Salomon didn't stop innovating afterward. You see, for homebuyers, a mortgage means taking on debt. But for lending institutions, mortgages are assets generating steady cash flow. Some cash flow repays investors' principal, some pays interest. These cash flow rights could be sold separately to different investors meeting varied preferences. So Salomon developed interest-only, principal-only strips based on CMOs. This split separated principal and interest risks and rewards, advancing the mortgage bond market further. That concludes the first thread, how Salomon Brothers started with home mortgages and created mortgage-backed bonds, then built collateralized mortgage obligations, CMOs, on those bonds, finally splitting CMOs into interest-paying and principal-paying debt certificates. Through these innovations, Salomon virtually created an unprecedented, massive mortgage bond market, reaping enormous profits. Salomon's bond traders previously handled just $5 million weekly. After entering the 80s with the mortgage bond boom, they could do $300 million daily. Securitization Wall Street turned illiquid assets into tradable securities. Then, via securities trading, pulled global idle capital and allocated it where needed, achieving efficient capital distribution. Money flows like this, under the baton of Wall Street's securities market, circulating worldwide. Next, let's look at the second thread, Lewis's observations and experiences. The book's author, Michael Lewis, was at Salomon Brothers during its peak prosperity. Lewis, who joined in 1985, was originally a master's graduate in economics from the London School of Economics. At a British royal banquet, he met the wife of a Salomon Brothers director. Through her recommendation, he joined Salomon as an intern. His starting salary was double that of a senior professor at LSE. With the high salary came immense workplace pressure, especially as an intern, earning well but unable to generate profits for the company. Most senior employees saw interns as burdens and money losers. Intentional or unintentional suppression and overt or covert humiliation became daily life. Some interns even developed elevator phobia, afraid to step out each morning. Facing intense pressure in the trading room, Lewis survived this environment and learned the first lesson of liar's poker. After completing months of internship training, Lewis did not enter the thriving mortgage bond department, nor could he stay on Wall Street. Instead, he was assigned to the London branch to sell corporate bonds. Fortunately, there he met two great mentors, Dash and Alexander, who were both teachers and friends to Lewis. Dash was a senior bond salesman who meticulously taught Lewis his unique techniques and style for selling bonds. Alexander was a senior trader who started in capital markets as a team with beast-like intuition for bonds, forex, global stocks, oil, precious metals, and commodities. Alexander advised Lewis to follow two patterns in trading. First, if all investors are doing the same thing, it's best to actively look for opportunities to go against the grain. For example, the American Agricultural Credit Cooperative once neared bankruptcy. Investors rushed out, frantically selling its bonds. But Alexander believed the U.S. government wouldn't let a major quasi-public financial institution with an $80 billion market cap providing credit to farmers go bankrupt. So while others fearfully sold, Alexander boldly entered, massively buying when bond prices hit rock bottom. Finally, the U.S. government indeed intervened to rescue the bonds. Prices rebounded immediately, and Alexander naturally made a fortune. Second, when major crises occur, like stock market crashes, wars, natural disasters, or OPEC production cut failures, investors shouldn't focus only on immediate gains, but consider ripple effects and their capital market impacts. For instance, when the Soviet Chernobyl nuclear leak happened, Alexander quickly judged that such a massive accident would severely limit Soviet oil and potato exports. He then decisively went long on international oil and potato futures, again profiting hugely as expected. To hone Lewis's market judgment and reaction speed, Alexander occasionally posed hypothetical crisis scenarios to test his responses. For example, he'd ask Lewis if Tokyo had a major earthquake and investors frantically sold yen and Japanese stocks, what would you do managing billions? Alexander then gave his judgment. Precisely because everyone fled Japanese markets, yen assets became severely undervalued, making it the perfect entry point. First, buy shares of Japanese insurance companies because their risks were largely diversified globally and decades of accumulated claim reserves gave them power to stabilize stock prices. Next, buy Japanese government bonds because the government would lower rates to encourage rebuilding. Low rates mean bond prices rise. Finally, buy yen because Japanese firms would repatriate overseas investments for reconstruction, selling dollars for yen, inevitably boosting yen value. But if yen already appreciated before his purchase, he'd sell yen instead because the upward momentum would be exhausted, followed by price correction. This was a trading philosophy full of liar's poker wisdom, shining with dialectical brilliance. Under these two mentors' guidance, Lewis grew rapidly. In a short time, he built a dense investor network across German, French, and British markets. During this growth, Lewis fought his turnaround battle by selling only real estate bonds, transforming from rookie to top player. These bonds had one key feature. They weren't backed by the company's entire assets. They were only secured by one New York office building. In 1986, real estate wasn't booming like today. Investors generally lacked real estate knowledge and property valuation skills, so these bonds got stuck with Salomon. These bonds were worth $87 million, an astronomical sum in the 80s, massively tying up Salomon's cash flow. If not sold quickly, major trouble would erupt. But this time, the company's established stars were ineffective. Despite exhausting all tricks, nothing worked. At this critical moment, Lewis stepped up, fully mobilized his European investor network, and finally sold the bonds to a French investor. Salomon instantly got off the hook and even netted $2 million. So, Lewis became famous overnight. Even company president Godefroy personally called to congratulate him. From then on, Lewis's career accelerated rapidly. By mid-1986, Lewis could leverage over $50 billion, generating annual net profits exceeding $10 million for the company, becoming a genuine top player. However, the good times didn't last. Salomon rapidly plummeted from its peak to rock bottom. By the 90s, it completely vanished from history. Lewis himself retired at his peak, leaving Wall Street in 1988. The arena. Lewis attributes Salomon's failure to two main reasons. First, its internal management and compensation systems were flawed, causing massive brain drain and market share loss. The internal factor. Second, while the external environment changed, Salomon Brothers remained shackled by past success, losing imagination and market instinct, becoming victims of their own achievements. Rapidly defeated by emerging competitors. The external factor. First, let's examine the internal factors together. Salomon's mortgage bond department achieved unprecedented profits. It should have been a good thing, but it exposed the flaws in the compensation system, where ability and income became disconnected. This was also a key reason why Lewis himself eventually left Salomon. In Salomon's HR philosophy, traders were just profit-making machines. Ultimately, the company provided the platform and opportunities, so all profits rightfully belonged to the firm. No matter how extraordinary the profits, bonuses were strictly capped. A trader earning $100 million might get the same year-end bonus as one making just $10 million. Under this system, star traders lacked loyalty. The very year Lewis joined, Salomon's mortgage bond department lost its 4 top traders to rivals. The only one who stayed was named Andy. The next year, Merrill Lynch made Andy an offer he couldn't refuse, quadrupling his salary. Panicked Salomon countered with a sky-high $9 million annual salary. Andy ultimately stayed, but this shattered Salomon's pay structure. Why should only mortgage bond people get million-dollar salaries? This ignited endless internal conflicts, draining Salomon's vitality. More importantly, Salomon completely misjudged top traders' value. In the derivatives era, success hinges on financial tech, markets, client relationships, capital flows, risk management, and efficient resource allocation. This crucial knowledge lives in top traders and fund managers' minds. They're the living soul of capital markets. Markets move by their judgments. Losing them is like handing markets to competitors. Now let's examine the external factor, the rise of junk bonds. Junk bonds are corporate debt from small or emerging companies, often with thin margins, weak risk resilience, and uncertain futures. Thus, their bonds carry high default risks. earning junk ratings from agencies. But these junk bonds offer high interest, yet struggle to attract investors. But Salomon Brothers' competitor, Drexel Burnham Lambert, simply refused to buy into this. Drexel's Michael Milken believed the U.S. credit rating system had major flaws, emphasizing past achievements over future growth potential. It was fundamentally inadequate for making objective, fair assessments. Good traders should ditch one-sided reliance on rating agencies, independently research companies' actual conditions, and make their own investment calls. This is where bankers' vision, courage, and expertise are tested. Top investment bankers often uncover hidden gems in the junk bond market. Milken not only thought this way, he acted on it. By 1985, he'd funneled tens of billions into the junk bond market. So, Milken virtually pioneered another bond speculation market single-handedly. Next, Milken devised a new strategy: leveraged buyouts. After acquiring an undervalued company, use its assets as collateral to issue junk bonds and cash out on the market. Here's the playbook. Milken would pick an undervalued firm, borrow heavily to buy its stock. After gaining control, he'd issue masses of junk bonds backed by company assets. Part of the proceeds repaid debt, the rest was pure profit. Thus, junk bonds morphed into corporate takeovers, booming from mid-1980s onward. M&A became a core Wall Street business. Finally, Milken even targeted Salomon Brothers. After stockpiling funds, he readied a hostile takeover bid for Salomon, using outsider tactics against a fellow Wall Street firm, unprecedented in its 200-year history. Though Salomon narrowly escaped, it was badly wounded by the ordeal. Under this dual internal-external assault, Salomon began its decline. By July 1987, a struggling Gutfreund fired mortgage bond chief Ranieri, followed by mass layoffs across the department. The mortgage bond department's rise and fall foreshadowed the whole firm's fate. So, by October 1987, Salomon's municipal bond and money market departments faced mass layoffs, leaving 500 to 1,000 senior Wall Street investment bankers unemployed. Afterward, Salomon Brothers lingered for 3 to 5 years before finally being acquired in the 90s. Merged away like a shooting star in Wall Street's history, leaving no trace. On the eve of Salomon's decline, Lewis prophetically resigned in 1988, leaving this historic Wall Street giant. In 1987, at his career peak, Lewis realized his modest seniority meant his million-dollar profits earned him a smaller bonus than underperforming colleagues. The main reason these colleagues got higher bonuses, simply joining 2 years earlier, this shattered Lewis's loyalty to the company. Internal power struggles, factional conflicts, leadership purges during decline, and liar's poker-style deception disheartened Lewis, who still saw himself as that idealistic young man. One night in mid-1988, Lewis called his father, saying he'd quit Wall Street to write a book with just $40,000 advance. After a long silence, his father said, "Maybe reconsider, stay at Salomon 10 more years, make a fortune, then write your book." But Lewis feared he'd lose his passion for writing in 10 years. He resigned immediately, focused on writing, and by 1989, Liar's Poker was published. Back to the book, we see how from 1978, Salomon seized historic opportunities from U.S. interest rate liberalization and the securitization wave, pioneering mortgage-backed bonds, CMOs, IOs, POs, creating America's premier mortgage bond market single-handedly, truly dominating Wall Street's capital markets in the early 80s. Lewis, joining then, grew with the company, rapidly transforming from rookie to top player. But over time, Salomon got caught up and surpassed by rivals. Its internal governance issues and outdated pay systems severely crippled its ability to handle challenges. The final outcome? Facing the emerging junk bond market, Salomon did nothing. Then rivals' hostile takeover attempts crushed it completely. It never recovered, fading away through the 90s. Overall, Solomon's rise came from understanding capital market dynamics and boldly innovating financially. In its downfall, well, exactly because it lost that innovative edge and courage. All right, that wraps up our interpretation of Liar's Poker. Find reading notes below the audio. See you tomorrow.